Welcome to this explainer on market bubbles. Look, we've all been there, right? You're sitting at a neighborhood barbecue and someone starts bragging about how they just doubled their life savings on a hot new tech stock or some obscure digital currency. Suddenly, their neighbor is buying a new boat, your coworkers are retiring early, and you're just left sitting there feeling like you completely missed the boat. That primal urge to jump in, to make sure you're not left behind, is incredibly powerful. But history has proven time and time again that markets absolutely cannot rise forever. What feels like a golden ticket is so often a financial trap. So today, we're going to diagnose financial mania, break down the psychology of why we constantly fall for it, and give you a level-headed survival guide to ensure that learning this lesson doesn't cost you your life savings. Think of this explainer as a medical chart. We're going to cover the diagnosis, the life cycle, the symptoms, patient history, the cure, and finally, some final thoughts. Section 1, the diagnosis. What exactly is a market bubble? So, what are we dealing with here? How does this condition differ from a normal functioning market? It's a term that gets thrown around a lot, but understanding its core mechanics is literally your first line of defense. A market bubble is, at its core, a psychological infection. It happens when an asset's price completely detaches from reality. Instead of buying a stock because the company's generating strong revenues and real profits, people buy simply because they assume someone else will pay an even higher price for it tomorrow. This is actually called the greater fool theory. Think of it like buying a single slice of pizza for $1,000. You aren't buying it because it tastes good or because $1,000 is a fair price for cheese and dough. No way. You're buying it because you're absolutely certain some greater fool is going to walk through the door tomorrow and buy it from you for $2,000. Here's the stark difference. A healthy bull market is fundamentally sound. It's supported by actual real-world economic expansion. Companies are selling more products, cutting costs, opening new locations, and generating measurable cash flow that goes right back into the pockets of investors. The price of the stock goes up because the underlying business is literally becoming more valuable. A bubble, on the other hand, is a total illusion. It's fueled almost entirely by raw investor psychology, momentum, and, frankly, greed. People are buying just because the line on the chart is pointing up. But eventually, the music stops. Reality always catches up. And when that illusion shatters, the underlying lack of real value is brutally exposed. Section 2, the life cycle. 4 predictable stages. Just like a virus, market bubbles follow a highly predictable 4-stage life cycle. And understanding exactly where you are in this cycle is absolutely crucial to surviving it. Stage 1 is displacement. It always starts with a very real, very exciting new innovation or paradigm shift. Think the invention of the railroad, the early internet, or artificial intelligence. There's a legitimate reason to be excited. That excitement then bleeds into stage 2, the boom. Prices rise steadily as the smart money gets in early, the financial media starts covering the rally, and the wider public starts to notice. This completely snowballs into stage 3, euphoria, where logic is just abandoned, which inevitably and disastrously shatters into stage 4, the crash. Now, stage 3 is without a doubt the most dangerous phase of the entire cycle. Euphoria hits. This is when new, totally inexperienced investors rush in, absolutely convinced that prices will never fall. Careful financial analysis is just thrown out the window and replaced entirely by blind speculation. There's an old Wall Street saying, when cab drivers and shoe shiners start giving you stock tips, it's time to sell. That is the essence of euphoria. Everyone is suddenly a financial genius. And to make matters infinitely worse, people start borrowing money to invest, trading on margin. By gambling with the bank's money instead of just their own, they pour absolute gasoline on the fire, driving prices up to stratospheric, unsustainable heights. And then, stage 4, reality finally catches up. The selling is usually triggered by a tiny pin pricking the balloon. Maybe the central bank raises interest rates, maybe a major company reports terrible earnings, or maybe the economy just slows down a bit. Whatever the catalyst is, confidence evaporates instantly. They say markets take the stairs up, but they take the elevator down. A brutal cascade effect kicks in. People panic and sell, which drops the price, which triggers margin calls, forcing more people to sell, which drops the price even further. Fear rapidly replaces greed, wiping out literally years of gains in a matter of weeks, sometimes even days. Section 3, the symptoms. 10 warning signs to watch. We can group the warning signs of a swelling bubble into 3 main categories: financial, market, and behavioral red flags. The financial symptoms appear when valuation metrics soar way above their historical averages. Take the price to earnings, or PE ratio. Simply put, this is how many years it would take the company to earn back the exact price you just paid for its stock. Historically, a healthy PE is around 15. In a bubble, you'll see companies trading at a PE of 100, 200, or even 1,000. Worse yet, you start seeing companies with zero earnings and absolutely massive cash flow deficits reaching multi-billion-dollar valuations. And behind all of this is that excessive use of leverage or borrowed money we talked about. The entire financial system becomes this fragile house of cards.
Let's put that into perspective. Imagine a neighborhood lemonade stand that makes exactly $100 in profit every single year. If the price to buy that entire stand suddenly jumps from $1,000 to $2,000 over a few months, but the kid running it isn't selling a single extra cup of lemonade, what exactly are you paying for? It's pure speculation. If an asset's price jumps 100%, meaning the stock price literally doubles, but the company's actual revenue and cash flow stay completely flat, the price has entirely detached from reality. You are paying double for the exact same amount of lemonade.
Next, we have the broader market symptoms. This environment is usually characterized by cheap money flooding the system because of low central bank interest rates. This easy liquidity basically makes borrowing free, pushing asset prices far higher than they logically should be. On top of that, IPO mania strikes. An IPO is when a private company first offers its stock to the public. During a bubble, hundreds of terribly weak, fundamentally flawed companies will suddenly rush to go public just to cash in on the frenzy. In past bubbles, you'd literally see companies add the word .com or AI or blockchain to their corporate name, even with no working product, just to watch their stocks soar on day one due to unquestioning demand. Finally, we hit the behavioral symptoms, and honestly, these are often the easiest for everyday people to spot. Inexperienced retail investors start treating the stock market like a social activity. We see this heavily on platforms like Reddit or X, where investing becomes a team sport or even a meme. The fear of missing out, FOMO, takes over completely. Decisions become highly emotional instead of mathematical. And the absolute biggest behavioral red flag of all, nobody talks about risk. The whole idea of what could possibly go wrong completely disappears. The only question anyone asks is, how high will it go? The ultimate behavioral symptom is extreme, blinding optimism. You know you're in incredibly dangerous territory when everyone starts repeating stuff like, stocks only go up, or every dip is a buying opportunity. But listen, there are 4 words that are widely considered the most dangerous words in financial history. This time is different. Human nature desperately wants to believe that the old rules of math and economics just magically don't apply anymore because of some new technology. But when absolutely everyone is bullish and everyone who wants to buy has already bought in, there are simply no buyers left to push prices any higher. A collapse becomes a mathematical certainty.
Section 4. Patient History. Famous Financial Bubbles.
Let's look back through history, because this is definitely not a new phenomenon. Back in the 1600s, during the Dutch tulip mania, people were literally trading their entire homes for a single tulip bulb because they thought prices would never stop rising. Fast forward to modern times, and we see the exact same pathology play out over and over. In the 2000 dot-com crash, companies spent millions on Super Bowl commercials with virtually zero revenue. When that burst, many internet stocks lost over 80% of their value, trillions vaporized. Then the 2008 US housing crisis. Easy credit meant people with no verifiable income were getting massive loans from multiple mansions. When they defaulted, it nearly broke the global financial system. And more recently, the 2021 crypto boom, where speculative fever had people spending millions on digital pictures of bored apes before a massive collapse. The asset changes, but human behavior? It's exactly the same. So after looking at all those devastating, portfolio-destroying crashes, you're probably asking yourself right now, if the signs are all there, can anyone predict exactly when the bubble will pop? Can we just time the market to get out at the absolute peak? The honest answer? No. Not even the most seasoned Wall Street veterans can consistently identify the exact day, week, or even month a bubble will burst. Trying to time the market perfectly is just a fool's errand. The famous economist John Maynard Keynes once hit the nail on the head when he said, "The market can stay irrational longer than you can stay solvent." That is a vital lesson. A bubble that makes absolutely no fundamental sense today can keep making no sense for another 2, 3, or 4 years before it finally collapses. So instead of trying to guess the top, successful investors focus on identifying these euphoric conditions and pivoting to manage their risk. Section 5. The Cure. How to protect yourself. Since you can't predict the exact top, you need actionable survival strategies. You need a financial vaccine to protect your wealth when those symptoms start flashing red. The cure involves aggressive, disciplined diversification. Do not leave your entire portfolio exposed to the hottest, most speculative sector of the moment. It also means strictly avoiding margin debt. If you only invest cash you actually have, you literally cannot be forced to sell in a panic by a bank. Stick stubbornly to business fundamentals. Look for companies that actually make a profit. And crucially, maintain healthy cash reserves. Having cash isn't just about safety. When the bubble inevitably bursts and fear takes over, that cash is your ammunition, allowing you to step in and buy high-quality assets at massive fire sale discounts.
Section 6. Final thoughts. Staying grounded. What is so deeply fascinating about this whole thing is that while the stories constantly change, from 17th century tulips to internet stocks to suburban real estate to digital tokens, the underlying human psychology remains remarkably, predictably consistent. Successful investing isn't about the thrill of the chase. It's not about catching every single euphoric rally or trying to time the top perfectly just to brag to your friends. It's about preserving your capital. It's about making rational, boring, math-based decisions. Good investing is often pretty boring compared to the thrill of a bubble, but boring is exactly what builds true generational wealth. Over long periods, disciplined investing will always, without fail, outperform emotional investing. So, as you look at your own portfolio today, in whatever market environment we currently find ourselves in, I want to leave you with this provocative thought to ponder. When you log into your brokerage account and prepare to make your very next purchase, are you truly investing based on solid, proven business fundamentals, or are you just afraid of missing out?